Here we are again, everybody. So this is from the introductory card. We're going to be talking mostly about exchange rates today, as well as the relationship of exchange rates to interest rates. So to start off with, if we think about interest rates sort of as the time price of money, which isn't really a perfect analogy, but it'll do here. That is to say, from the supply side, we can think of interest rates as sort of a return to waiting, right? So I'm not going to consume today, I'm going to consume in the future, so I get a rate of interest, or a return for that, we call that the rate of interest. Of course, that's insufficient to explain rates of interest. If we also need to add to it a demand side, that the idea that interest rates are returned to waiting, in the sense that if I borrow money, right, I can put that money to work right now and presumably earn some kind of return from it. And this is why I want that supply of liquidity. Okay, exchange rates are actually a very similar and related idea. I like to use the analogy that exchange rates, are the space price of liquidity. So if I need liquidity in the United States, I need US dollars. If I'm in the United States but I need liquidity in Canada, I need Canadian dollars. If I would like liquidity in Japan, I need Japanese yen. Okay, so depending upon the economic space in which I need to operate, I need to engage the appropriate currency exchange market or foreign exchange market. And so once we start thinking of exchange rates that way, it's sort of natural to think that there'd be a linkage between the two. And so that's what we're going to see here. And in coming lectures, we're going to probe into it in much greater detail. Okay, the conventional way of expressing those ratios is to express the units of the local currency in the numerator to the units of the foreign currency expressed in the denominator. So for example, if it takes 2 US dollars to buy 1 euro, we would generally see that exchange rate, dollars to euros, being expressed as 2 to 1, right? Or even just 2, okay? Not always the case. So you need to understand how those currencies are being expressed. So here's some examples, right? So generally we would see the US dollar to euro exchange rate look something like that. So that would be saying that it takes $1.15 to buy 1 euro, which is ballpark where the exchange rate is today, right? So this is late 2020. Right. So this actually creates some counterintuitive ideas. So for example, if that ratio increases, right, meaning that the numerator is increasing relative to the denominator, or the upstairs number is getting bigger relative to the downstairs number, as one of my professors used to say it, the US dollar is depreciating, right? So even though the ratio is going up, it's a depreciation, which can be real confusing. And now, before I go any further, you also need to understand that exchange rates in and of themselves, they don't tell you anything about whether a currency is quote unquote weak or strong. Okay, so sometimes I'll hear people say like, it takes 100 Japanese yen to buy $1, so therefore the Japanese yen must be weak and the dollar strong. That isn't the case at all. The numerical units of a currency tell you nothing about how weak or strong that currency is. When people talk about currencies being weak or strong, what they mean is the purchasing power or the buying power of that currency. So for example, if I take my US dollars and convert them to Mexican pesos, and then I, go and take a vacation in Mexico, I find that my income goes further in Mexico, right? So things appear to be cheap in Mexico if I'm coming from the United States. That's what strong and weak means. So in that case, the US dollar is relatively strong with respect to the Mexican peso. When we speak of a currency depreciation, so when you hear somebody say X currency is depreciating, first of all, you need to understand that in terms of what you're talking about. So the currency is depreciating. Okay, how? Is it depreciating against the yen? Is it depreciating against the euro? Is it because of course the currency can be depreciating in some aspects and appreciating in other aspects. And in fact, almost always is. For sure, if we look at the foreign exchange markets today, we're going to find the US dollar depreciating against some currencies and appreciating against others, which makes the matter very confusing. So we need to be extremely careful when we're looking at this kind of data to make sure we understand what we're talking about. Okay. Now you might be saying, why does this all have to be so complicated? What is this here? Well, the reason that what makes rudimentary international finance so much more complicated than simple an application of basic microeconomics or macroeconomics is that everything is expressed in relative terms, right? Which is always the case. But when we're looking at prices within the United States, I'm speaking to you from the United States now, we're looking at prices within the United States. All those prices are being expressed relative to the dollar, the US dollar, right? I mean, if somebody asked me, well, what's the price of bread at the store? I could quote them in euros, or I could quote them in Japanese yen and tell them like, oh, well, the bread's about 90 yen. Now, in addition to these verbal and mathematical differences, right, we also now have an additional source of potential volatility in terms of prices, right? So if we're a business doing business in a foreign country, we've got to think about foreign labor costs and how they're moving, other foreign land rental costs, so on and so forth, foreign interest rates, which we're going to come back to in a minute. But then we also need to think about what's going on with the exchange rate. So exchange rates introduces another level of complication, not just in terms of our own price formulations, but in terms of general market volatility. However, of course, you can easily have 10 to 15% volatility in exchange rate over a given year. Okay, so consider that. Let's say you've made 15% on a business you own in Canada. However, the Canadian dollar has lost 15% against the US dollar this year. Well, that means in terms of US dollars, you know what you made? Nothing. Okay. Why? Because the 15% profits, sure, you made it in Canadian dollars, but when you went to convert your Canadian dollars back into US dollars, you found you had 15% less US dollars, and therefore your profits are gone. Okay. So exchange rate volatility is a quite serious issue for international consumers, but even more so for international business operations. Okay, so let's shift gears then and start talking about the different foreign exchange markets that one would encounter, just by picking up the newspaper or by doing a quick internet search. Usually when we hear exchange rates being quoted, it's referring to the spot market. Now, the spot market is the ratio of the ratio of exchange for currencies at the current moment in time. So if I wanted to call up my broker and buy Canadian dollars right now, the rate that I'm going to get quoted is the spot rate, right? And it's actually, he's going to quote me a rate, or she's going to quote me a rate just off the spot rate, because of course the bank is going to mark up a little bit or mark down depending upon what I'm talking about. In other words, they're going to make a little money off that exchange too, right? So when you're actually looking at doing currency exchanges, being aware of the spot rate is quite useful, because then the differentiation between what you're being charged and what the spot rate is the price that you're being charged for the currency exchange, and those can vary significantly. There's also forward markets. Okay, forward markets are the price today for a given amount of currency, given amounts of fixed quantity for a given amount of currency delivered at a specific point in time in the future. So let's say I want to receive 10,000 euros in 3 months' time. Okay, there's a forward market that I can purchase those euros today, to be delivered in 3 months. Now, why would I want to do that? Well, let's say that the exchange rate is quite favorable to me now, and I think it's going to get worse over the next 3 months. In other words, become less favorable to me. If I want to lock in that price today so I can plan my business operations for the coming months, okay, great. I'll buy in the forward market. Now the price is locked in, and I've eliminated that exchange rate volatility that we were just discussing a moment ago. Okay, forward markets. A swap arrangement is a spot transaction with a forward repurchase agreement. Transaction, let's say I have extra euros today. Maybe I just went on a vacation to Europe or something like that, and I had a bunch of euros left over. And so, but I don't need them now, but I'm going to go back to Europe next year. And I'd really not like to I'd like to know how many euros I'm getting back. Okay, I might do a swap. So I'm going to say, okay, I'll lend you my euros today at this price, spot mark, but I also want to guarantee that I can get those euros back in 1 year's time at this given price that we are agreeing upon today. This is a swap arrangement. So there are always new types of swaps being created because that's what both the supplier and demander want. Okay, so if you're saying like, well, could I create a swap arrangement where I buy it back in 215 days? Sure. There'll be somebody out there who wants to do that. So contact, your local large bank, and for sure they can facilitate that transaction. Swap arrangement. Okay. Futures markets. Okay. Similar to a forward market, but the difference is that the arrangement can be bought or sold prior to it being redeemed. So let's say I want to, I'm going to travel to Europe, or my business is going to build a factory in Europe in 6 months' time. And I'm concerned about the exchange rate. So I'm going to lock in that price today. I want to eliminate that exchange rate volatility. Okay, well, one option for me to do would be to purchase that currency on the futures market. That is to purchase the guarantee that I can buy euros in 6 months' time at this given price. Okay, you might say sounds just like a forward arrangement. Yes, that's right, because so far it is. The difference is let's say in 3 months' time, so I'm going to build the factory in 6 months' time. 3 months from me settling that arrangement, the European economy goes bust and my firm's like, forget about it, we're not going to build that factory. Well, in a futures arrangement, I can now sell that to somebody else. So let's say it's still a good deal, right? Like I'm still going to be buying euros for cheaper than I think I'm going to be buying them in 3 months' time. Well, for sure, somebody else is going to want to buy that arrangement. There's a whole ton of ways in which you could sort of use futures markets then, right? Of course, speculators are constantly using futures markets, right? So if you think that a currency is going to appreciate more than everybody else thinks it is going to, then for sure you want to buy it today on a futures market, right? And then as it starts going up, right, then now you can sell it. Okay, and you can make money that way, right? So futures markets are of any type, right, allow you to essentially bet on future performance of a currency. Doesn't matter whether it's going up or down. There's a futures market that will allow you to speculate on that. Finally, options markets. Okay, options market is where I reserve the right to be able to buy. So I'm not actually agreeing to buy or sell. I'm agreeing to have the right to buy or sell. So I might say, okay, well, I want to have the option to buy this currency at this point in time in the future. I'm not actually agreeing to buy it. I'm saying I want you to reserve the option for me to buy it or for me to sell it. Okay, one's a call and one's a put. You can see right over here which is which. Okay, this is an option market. So futures market, forward markets, you're actually saying I'm going to buy this or sell this, right? Options market, no, I just want the option to buy or sell this at this price at this given time in the future. What are they all? All of these markets, excepting the spot markets, are ways to hedge or mitigate volatility in exchange rates. Okay, and we talked about why you would want to do that in the beginning. If I'm running a business selling shoes around the world, I don't want to deal with exchange rate volatility impacting my business one way or another. I want to lock that thing in, and I want to focus on selling shoes. Derivative markets, all these markets except the spot market are all what's called derivative markets. And they're derivative in the sense that they're derived from the spot market. Okay, so the forward market, the futures markets, the swaps, all that, they're derived from the spot market. Derivatives. Okay, that's a word that people get scared with a lot, especially in the last 10 years after the financial crisis. Commentators would be like, these scary derivative markets, blah, 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 nobody can understand. Guess what? I just taught you about half a dozen derivative markets, and they're not that complicated. Not to say that all derivative markets aren't complicated, right? They can become incredibly complicated, but the basic idea of a derivative market is not complicated. So here we have what's referred to as the covered interest rate parity condition. In the next lecture, I talk about the uncovered interest rate parity condition. What we have here is just a illustration. So this is the forward rate. This is the current exchange rate, dollars to euros. This is the foreign rate of interest. This is the domestic rate of interest. So what do we have here? We have an illustration of the idea that if we have variations in interest rates, so in other words, we have different prices being paid to capital around the world, the adjustment between those tends to occur in the exchange rates. Movements in exchange rates take up differentials between relative returns on capital, right? So if relative return on capital is here is high and here it's low, what that prompts is an alteration in currency prices. Again, all things being equal, so same risk, so on and so forth. Alteration in currency prices to take up those differences. Okay, so one impacts the other and vice versa. All right, so here's explanation of that, of all those variables. By the way, all the little pictures here are currency signs, right? Currency symbols for different countries. The first one was the dollar, and then the euro, and play a little game and see if you can figure out what they all are. It wasn't equal, so let's say this parity condition wasn't holding this one, so this is not equal. Let's just say that it's this way. So the exchange markets are such that this ends up being greater than this, or the left-hand side ends up being greater than the right-hand side. What we would find then is that global capital would move towards the United States in this case, or the dollar-denominated asset, and away from the foreign-denominated assets. In other words, in that case, the current exchange rate as well as the forward exchange rate is too cheap to fully take up the differential between the rates of return on capital, and so capital starts moving. Now, if capital is moving from the Eurozone to the United States, or the dollar zone, right, what would we expect to happen in exchange rates? We would expect the euro to start losing value and the dollar to start gaining in value. In other words, for that ratio, right, to fall. So then summarizing all of this, right? Okay, foreign exchange, as I said, is sort of the space price of liquidity. Movements in the foreign exchange introduce an additional level of volatility. So these are restatement of the learning goals, right? Many foreign exchange markets, derivative markets attempt to mitigate volatility, and foreign exchange and capital markets all, of course, so capital markets, right, determined by rate of interest, right? Those markets all impact each other. All right, thanks very much. We'll see you next time. Have a great afternoon.